My name is Jake, welcome to the channel. In today's video, I'm going to share my thoughts on DIVB. This is the iShares Core Dividend ETF. The way that you can kind of think about this ETF is it's very similar to DGRO. And if you follow my channel, you know that I talk a lot about DGRO. It's part of what I like to call the simple path to wealth with dividend investing, which was inspired by J.L. Collins, where you have a core portfolio of, dividend ETFs like SHD and DGRO if you want to, retire off of your dividend portfolio, and you combine that with satellite positions. So if you're a longtime subscriber of the channel, you've heard me talk about this so much, but the reason why I talk about it so much is that it really helped me. I really wish that I would have stumbled across this a long time ago, and the reason why I talk about it so much is I'm hoping that I can help somebody out there to really kind of see the light when it comes to, if they want to retire off their dividend portfolio. This is a great framework that anybody can implement and use as a guide to help them to one day live off of their dividend portfolio. But yeah, if you're new to the channel, once again, my name is Jake. I retired from my 9-to-5 job at the age of 37 last year. I reached what is called barista fire. So I live off of my dividend portfolio as well as I work part-time on the side. I'm not a barista at Starbucks or anything like that. I make YouTube videos and share funny cat memes, and that's how I make a living. I don't take myself too seriously, and I like to, laugh, even if it means laughing at myself and the mistakes that I've made. But yeah, so if you're new, welcome. So in today's video, I'm going to cover 4 things. First off, I'm going to take a look at DIVB itself. I'm going to give an objective overview of what this ETF is, take a look at some of the past performance. And then the second thing we're going to take a look at is the index that it follows. This is by far the most important thing that you have to understand when you're investing into any ETF is understanding the index. This is a rule-based index. It's not an actively managed index or fund, I guess. It's based off of the rules of the index, and this fund will perform based off of these rules. And if you don't understand these rules, well, you probably should watch this video because it's very important that you understand it. The third thing we're going to take a look at is I'm going to compare DIVB, DGRO, and the S&P 500 side by side. I'm going to look at their fund overlap. I'm going to share with you, kind of the differences and things that you have to look out for and understand, when you're investing into these individual ETFs. And then lastly, I'm going to share my opinions on who should consider investing into an ETF like DIVB. Now, a video like this may seem like I'm comparing ETFs for the title of the greatest of all time, like, comparing Kobe versus Michael Jordan, who was better in their prime. And so when you're looking at a comparison of Kobe versus Michael Jordan, one player may have better stats, but you could also argue that the time in which they played, the game was different back then when MJ played versus when Kobe played, at least, at the end of Kobe's career. Now, I wouldn't suggest looking at DIVB versus DGRO or SHD or any other dividend ETF like comparing Michael Jordan versus Kobe for the greatest of all time, mostly because it's a waste of time because MJ is just obviously better and is the greatest of all time. So I'll settle that debate right here now. So we don't have to spend time on that debate, but when it comes to dividend stocks and ETFs, you're always going to see people in the comments sharing their opinion like it's the gospel and that they know better and always want to tell you you're wrong and they're right. Because people love to fight over which ETF is better. And it could look a little like this. Oh man, I love it. I love it. All right, cool. So let's take a look at DIVB. I'm going to walk through, give you an overview of this ETF, and then we're going to dive into the fund methodology. So first off, when I'm looking at an ETF like this, so remember, I'm sharing my thoughts on this ETF. I'm going to give you an objective overview of what it is. The very first thing that I look at here in Seeking Alpha is I'm going to first look at the expense ratio. Okay, so the expense ratio of DIVB is actually very low. It's actually lower than DGRO. And I would look at this ETF kind of as the smaller brother of DGRO. Okay, very, very similar in that the index comes from Morningstar, which we'll get to in a second, but that's kind of how I categorize this ETF. Okay, so the first thing that I want to take a look at is I want to look at some of the different metrics. I want to walk through some of this with you and just understand that this ETF has only been around since about the end of 2017, so only a handful of years. And so when you're back testing this and where we're looking at this, just keep that into consideration that we don't have a lot of data when it comes to this overall, the overall metrics when benchmarking it and comparing it to other ETFs. So right off the bat, that catches a lot of people's attention is the extremely high dividend growth rate. So at face value, this looks really, really attractive. Okay, so it's got a 16 plus 5-year dividend CAGR. However, I'm not quite sure that this is going to be sustainable, and this has to do largely with the turnover rate of this ETF. And if I show you here really quick, if we look at the turnover rate, you'll notice that this ETF has a turnover rate of 36%. So every year, they're swapping out 1/3 of the companies in this index. That's a lot. And, by comparison with DGRO, for example, DGRO has around 25, I think 26. So about a quarter of the holdings are being swapped out every single year. So the reason why I'm showing you this is I wouldn't just go and say, hey, look, it has, a 22% dividend CAGR. That means it will continue. I would be very skeptical of that, okay? And it largely has to do with the turnover rate. Not a lot of people talk about this, guys. Not a lot of people even understand what turnover rate is. If you go on YouTube, nobody's going to talk about turnover rate because it doesn't generate clicks, but it's so, so important that you understand what it is and how it impacts your ETFs if you're investing in ETFs. So that's the first thing is we want to look at the dividend growth. The next thing that I want to take a look at is the yield on cost. So if you were to invest into this ETF, if let's say you had an initial investment 5 years ago, your initial yield on cost of that initial investment would be just under 4.5%. It's currently yielding about 2.5%. Okay, so the yield on cost with this ETF is very, very good. But like I said, there's a big but. I'm a little bit concerned with the turnover rate. And one of the reasons why I'm a little bit skeptical of this dividend growth is when it comes to the quarter over quarter, year over year dividend growth. So they had a massive spike in their dividend growth in 2023. But a pro tip here, if you are looking at the dividend growth, don't look at it for June compared to March. What you want to do, this is a pro tip, you want to compare it to the same quarter, but from the previous year. So you don't compare June versus March to get the dividend growth, just for you. Like this is how I do it. If you want to level up your game and really understand how to look at this, what you want to do is you want to compare June of this year versus June of last year and March of this year versus March of last year. Okay, so that's how you want to look at this. And if we compare, 2022, in March of 2022, they had a per share dividend of 16 cents. The next year in 2023, they doubled their dividend. Okay, and that's how they were able to get that massive spike in their dividend. Now, they do, and we'll get to this in a second, they do a reconstitution of their holdings. They switch them out annually in June, okay? And so my assumption is that here, so they swapped out their holdings here in June of 2022. And so you can see that's when the dividend started to spike. And we talked about that where they have a turnover rate of 36%, about a third. So it's kind of hard to guess, is this going to continue in the right direction or the wrong direction? Okay. And that's where I want you to kind of, look at this objectively and try to understand, okay, there is a risk that it could go down and up. It's possible that it doesn't go up consistently year over year. And my gut tells me that in 2024, they're going to have a decrease in their income compared to 2023, which will dramatically decrease their dividend growth rate track record. So, but that's speculation. Okay. I don't know. I don't have a crystal ball. Okay. So when you look at that, they doubled their dividend in 2022 to 2023 in March. They increased it in June also. But one thing that you'll notice here in 2024, they've actually decreased their March dividend from 31 cents a share to just about 25 cents a share. Okay, so that's the reason why I'm showing you this, is that you don't just go over here, you're a complete noob, and you go to the dividend growth history and you're like, whoa, massive spike in the dividend. This is the best thing since sliced bread, right? Like, holy cow. No, calm down. Take a second, breathe, and try to understand, okay, is this reliable? Can this be, can they sustain that year over year? And I would be critical of this. And that is why I'm taking so much time in this video to make sure that you understand that is a real risk. And it comes back to the turnover rate. All right, next thing that I want to show you are the holdings. Okay, so it does have a heavy chunk in technology, but you'll notice this is not the traditional technology that you may be familiar with, Microsoft, Apple, Nvidia. No, they have a very different view, or they take a very different approach when it comes to the technology stocks that they add. And you'll see here that they have basic materials at the lowest, and they have a small sliver of real estate. So it's agnostic to sector agnostic. They include everything. And so that's what we'll get to here next in the fund methodology. But you'll notice here that Cisco and IBM are the largest holdings, which is pretty interesting, right? When you compare that with DGRO, the largest are Microsoft and Apple, which is more of a traditional kind of a way of, how these dividend ETFs are set up. So it is very different. I mean, you got Verizon in here in the top 10 holdings. You got a Chevron, Johnson & Johnson, Fidelity. So the top 10 holdings are very different than when looking and comparing it to DGRO as an example. Something that I really like about this ETF is you don't have too much concentration in the top 10 holdings, under 30%, which I really like. So it's not super top heavy. And something that I also really like is they have over 400 holdings, very, very, very similar to DGRO. All right, the next thing that we're going to take a look at, and this is one of the most important things that you look at when you're considering a dividend ETF, is you go over to Seeking Alpha or a similar website, and you go and you read the fund profile. And what you're trying to look for is you're trying to understand what is the index that this ETF tracks. And this index, what it's tracking is the Morningstar US Dividend and Buyback Index. Okay, so this is not created by BlackRock or iShares, right? They're using an index that was created by Morningstar, and also very, very similar to DGRO. That's why I'm saying this is DGRO's little brother. So if you Google the index name, you're going to pull up a website here from Morningstar, and you're going to have different options. You're going to be able to see the different holdings. You're going to be able to see, different pieces of information. What I like to do is go into the documents section. And what I want to read is how the index is set up. What are the rules of the index? So we're going to do exactly that. We're going to look at the rule book of this index, and they have an entire PDF dedicated to the rules of this index. So the way that this works, the methodology for this ETF is the starting universe is looking at the US market, and it's looking at the top 97% of the investable market, right? So there's over 3,000 or so publicly traded companies. It's looking at the top 97% of the publicly traded companies in the United States. And the eligibility to be included in this index, now this is where it gets a little bit confusing, so stick with me here. This is a little bit confusing. In order to be eligible, a company must have a total shareholder yield greater than 0.1%. Now, I'm sure that 99% of you watching this video don't know what that is, okay? And I'm going to explain it here. They explain it here in a second. So it's a little bit confusing. It's not as straightforward as other indices that we've looked at on my channel. So the next thing here is that companies must not rank in the top 5% by total shareholder yield. And then the portfolio construction is eligible securities, eligible companies are ranked by adjusted shareholder yield. The top ranking stocks are targeted for inclusion until the index reaches 50% coverage of the starting universe by the total shareholder payout dollars. And then the index is weighted by total shareholder payout dollars subject to security and sector constraints. Okay, so the eligibility, so let's take a look at what is this total shareholder yield. So securities with total shareholder yield above 0.1% are eligible for the portfolio. Total shareholder yield is a combination of dividend yield and net buyback yield. So buybacks are when companies use cash on their balance sheet to repurchase their own shares. Okay, so fewer shares on the market means the existing shares that are left over go up in price. And companies only issue, share buybacks if they're in a position where they're not necessarily in hyper growth mode, but they've captured the total addressable market that they're satisfied with, that they're working in. And that's when they start doing share buybacks. Okay, so you're not going to hear startups generally, issuing share buybacks, right? They want to use that capital, that cash, to grow their business and to obtain more market share. Okay, that's generally how it works. So if you're not sure with what buybacks are. So a securities dividend is not required to be qualified income. For example, real estate investment trusts are included. Net buyback yield is averaged over the most recent 8 trailing quarters. Companies in the top 5% per total shareholder yield in the eligible universe are screened out. Okay, so it's a combination of dividends and net buyback. And so if you're just a new investor and you're reading this and you're like, huh? Well, you got to do a little bit more research. You don't want to just go blindly invest into an ETF because, guys, this is it. This is what you're investing in. When you're investing in a DIVB, you're investing into this. Okay, got it? Good. All right, perfect. So the securities are selected from the remaining universe based on adjusted shareholder yield, which is a combination of Windsorized dividend yield Z-score and net buyback yield Z-score. Securities are selected in the priority order of decreasing adjusted shareholder yield and until 50% coverage of the aggregate total shareholder payout dollars are of the starting universe is achieved. Okay, cool. And the index weights are further constrained by maximum security caps of 4.9%. I like this. So they can't, no one single stock can be represented more than 5%. I like that. And sector constraints at a plus or minus 5% with respect to the benchmark index. Since total shareholder yield can become negative or zero, companies with non-positive yield are removed from the index at rebalancing and do not participate in the weighting algorithm. Okay, and so how does that work? Well, the way that it works is when a company is above or below that threshold, the index is reconstituted where the membership is reset annually on the third Friday of June. So they that turnover rate every single June, you're going to see about a third of the holdings come in and out on an annual basis. At least that's what it's been historically. And then the index is rebalanced quarterly. That is how they maintain those thresholds because they're rebalancing quarterly. Rebalancing, you're keeping your existing shares. You're just changing the percentages, the weightings based off of this right here. And after, on an annual basis, if a company falls out, they're replaced with another company. So that's how the index works. Now let's go back into Seeking Alpha and let's do a comparison of DIVB, DGRO, and VOO. So VOO is the Vanguard S&P 500. And so let's take a look at it. So the inception of DIVB was 2017, DGRO 2014, and VOO 2010. The expense ratio, all very low, but DIVB, this is notable, does have a lower expense ratio than DGRO. I do like that. Although the assets under management are significantly lower, this is a bit confusing to me. I mean, this is, a good ETF, but why do they only have, less than 500 million in assets under management since 2017? This is a little bit, I guess, they obviously, this is a low expense ratio. They have no incentive, I guess, to promote this, talking about iShares. Why would they promote this when they can promote some of their other ETFs that have a higher expense ratio where they're making more money? So, it's kind of an interesting thing there. These issuers, these funds, they want to promote their ETFs with higher expense ratios. So that's kind of a theory or just a guess. I don't know if that's the case. Or maybe it's just not as popular. I don't know. But let's take a look at the price performance since the inception here. So beginning of 2018, when looking at these three, you can see here that the S&P 500 has performed the best. Now, when we compare the total return, this is what we want. We want the total return with the dividend reinvested. With the dividend reinvested is where you're going to get the total return. You'll notice here that the S&P 500 has still outperformed, and DIVB has actually outperformed DGRO just slightly. But you know what's interesting? I always like to look at pre-pandemic, post-pandemic, and pre-pandemic, they were neck and neck. And now the multiple expansion for technology stocks has expanded, and there's more technology in the S&P 500. So there's really no wonder that the S&P 500 has such high outperformance over the last couple of years. So that's something that you want to take into consideration. You don't just want to pull up a chart and be like, oh, this one has performed the best, therefore buy it. Dave Ramsey. I always think about Dave Ramsey when I think about that. Because I remember reading his book, Total Money Makeover, and listening to him. He's like, yeah, dummy, just go buy the ETF or the mutual fund. Go buy the mutual fund with the best performance. I was like, okay, Dave, thanks. Which one? Can you help me out here? No, just buy the best one and you figure it out. Because man, that was such a challenge. I could rant on that for hours. I don't want to bash my friend Dave, but that was the advice that I got when I first started investing. Go invest into growth mutual funds that have 14% performance year over year. Go invest into that one. Come on, man. Ugh. I'm sure there's tons of you out there that can relate to that. A lot of great advice, but when it comes to the investing, man, it set me back years and years, and confused the heck out of me. But yeah, anyways, in terms of the grades for these are, the quantitative grades from Seeking Alpha. They're all very, very highly graded. In terms of the dividends, this is important. The trailing dividend with the share price and the yield per share now, you'll see here that DIVB does actually have a higher dividend yield, forward dividend yield. That's questionable if it, depends on how the holdings change, right? So that's a big, big question mark going forward, is how will the fund change year over year, and will it maintain that outperformance? In terms of the 4-year average yield, very, very similar with DIVB and DGRO, obviously beating VOO. And the dividend CAGR, here you got 22. Yeah, we already talked about the dividend CAGR, but I think I'm very critical when it comes to this dividend CAGR. I think you're going to get something closer to what you're seeing with DGRO over the long term. But, time will tell. We'll have to see. And then lastly, here we talked about the turnover rate. DVIB has 36%, DGRO 25%, and VOO only 2%. So very notable. Next, what we're going to do is we're going to take a look at the fund overlap comparing DIVB with DGRO. And what you'll notice is they have by weight 50% overlap. This is good overlap, but it's not so much where I would say you should only do one or the other. This is enough where I would say you could include both of these. There's no reason to have to say you have to have one or the other. I could definitely see a case where you could have both of these ETFs and live happily ever after. I would not be so, set in the mindset of you could only have one or the other. I think, if you follow the core and satellite approach, which I'll talk to here at the end of the video, this is absolutely something that you would want to consider. And I could definitely see a case where you could include both of these. But when you compare, what are some of the differences? Now, when you're investing into DIVB, you're getting more Cisco, Texas Instruments. And then with DGRO, you're getting more Apple, Microsoft, Broadcom, United Healthcare, okay? Which is a lot more closely aligned, I guess you could say, with by market cap with the S&P 500. So you're going to have more of a traditional mix like that. So I was actually very intrigued by that, you got Pfizer, you got Verizon, AT&T, in some of their top holdings, and very, very different than DGRO. Next, let's take a look at a comparison of DIVB and VOO when it comes to the fund overlap. And you'll notice here that it only has a 31% weighted overlap with the S&P 500. This is not a lot, okay? 31% is not a lot. I would not be comfortable going heavy into DIVB simply because you're not getting a lot of exposure to the the S&P 500 or the US market. Now and because of that, you would want to combine DIVB, taking a hypothetical. If you're like gun-ho on DIVB and you want to make it a core position, you can do that, but I would highly encourage you to combine it and couple it with an ETF that captures more of the overall market. I'm kind of I'm a boglehead at heart, but I'm not a purist, right? I do believe in efficient markets, though I actively, select dividend ETFs. All the bogleheads, I'm sure, look down on me, and I look down, it's mutual. But the point that I'm making here is 31% is not a lot of market participation. I would encourage you to try to combine this with another ETF where you're getting more market participation. Okay. And if you don't understand that, you probably have never heard of the bogleheads. You probably have never heard of, it's important. I believe that the more market participation that you have, the better. Okay. So that's just my opinion. Now, when comparing that, DGRO versus VOO, you can see that there is a lot more market participation. And that's what I was saying. DGRO tracks more of the traditional market by market share than, DIVB. Okay. And just to be to throw this out there to make a really big point, SEHD only has 8%. And so if you believe that market participation is a good thing, then you would absolutely want to combine SEHD with something else. That's why I combine it with DGRO, the simple path to wealth with dividend investing that I talk about. That's so important, and that's why I combine it. But the market participation is not talked about a lot here on YouTube, but it's so important that you understand, because you don't know what the market's going to do. I don't know if we're going to have a raging bull market in technology for the next 50 years or 10 years. I don't know if healthcare is going to outperform or underperform materials. You just don't know. And so by having more market participation, you don't have to guess. You don't have to know. Okay. And the market figures it out, and you get to enjoy the ride. So now that we all understand what DIVB is, we understand the index, we understand how it's performed historically compared to DGRO versus the S&P 500, it's held its own and has performed very, very well. Now, DIVB is more of a dividend growth ETF. Though the index does not directly call for dividend growth, it's not sole purpose is dividend growth because it's focused on buybacks. I think that the fund methodology, the index, is very interesting. I love the low expense ratio. Many times the expense ratio is a make it or break it for me. And the fact that it even has a lower expense ratio than DGRO is a huge plus. Okay. And so someone who should consider investing into DIVB is someone with a longer time horizon, right? Someone who has, 10 plus years before they plan on living off of their dividend portfolio. However, if you have a shorter term time horizon and you want to include DIVB, I would limit the amount that you have in it, very similarly to the way that I suggest it with DGRO. So kind of like the way that you can think about this, if you follow my channel, is think about DIVB similar to DGRO and how you would combine it and include it into your portfolio. Now, however, I personally like the index more of DGRO. I prefer the index of DGRO. I believe it is more a survival of the fittest type of approach, and that's why I like it more. It also has more market participation. So for me, DGRO is a core position where I would not consider DIVB a core position personally. Now, if you wanted to have DIVB as your core instead of DGRO, go to town. You could absolutely do that. Everything that I talk about on my channel is you should view it as a guideline, not a rule. Okay, because there's different strokes for different folks. Everybody has a different time horizon, strategy, understanding of what they're trying to do. But for me personally, I like combining SEHD and DGRO as your core. We saw the fund overlap just a moment ago. I think that that is a really good mix, a good balance, having DGRO and SEHD. And if you wanted to have DIVB as a satellite position, I think that that is absolutely fine. Now, the satellite positions, you could have it up to, 20% for an example, right? I think having DIVB at, 5 or 10% would be absolutely reasonable. If you wanted to go gun-ho on it and have 20% of your overall portfolio, you have my blessing. But yeah, like I said, I do not consider DIVB a core position in my portfolio. And I think most people would probably do better in the long term. Judging, if I put on my tinfoil hat and pull out my crystal ball, I think DGRO is probably going to outperform over the long term or be very, very close. I just like the index better with DGRO. And so the one thing, like I said earlier in the video, you want to be very careful with the turnover rate with DIVB. The income is likely to be inconsistent, right? You're probably going to have years where it goes up and years where it goes down. So I would just definitely have that on your radar, that some years it may go down, some years it might go up, simply because of the, how high the turnover rate is. Keep in mind that DIVB does have a small percentage in real estate. It's not really material where I would, it's not a game changer for me. I could hold, DIVB in a taxable account. But yeah, it's not something that you have to lose sleep overnight. 3 or 4% into real estate it's not going to break the bank. Just how I personally see it. But yeah, all in all, I definitely see DIVB. If you follow my channel and you follow the core and satellite approach, I see DIVB as a great candidate for a satellite position. I give it my full stamp of approval. If you want to add it to your satellite position, go to town. I think that's absolutely, something you could consider. I do like DIVB. I personally will not be including DIVB in my portfolio, even though I think it's an interesting ETF, at least not anytime soon. I have enough holdings in there, my portfolio where, I just don't have room for it now. I'd have to sell other holdings or something like that. And if I was working, if I could go back, 5 years or 10 years, would I consider adding it? Maybe. And, but that's just my personal opinion. But if you want to invest in a DIVB, I give you my full stamp of approval. And yeah, I think it's an interesting ETF. It's an interesting index. Well, I hope the video was helpful for you. I hope that you learned something new. I know that there was quite a few technical terms in this video. I know a lot of you are new investors, and so some of this may have went over your head. The main message that I want to, come across when I review these ETFs is make sure that you're taking the time to really understand what the ETF does. What are the rules of the ETF? Because if you understand that, whatever the market does, it doesn't matter. You understand why you're investing in the ETF. And, it's a little bit cheesy, but knowledge is power. And so if you understand how ETFs like this function and work and how the rules are set up, more power to you. But yeah, thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.